In this video, we're going to talk about cash and cash management. So we'll start off by talking about why cash is important and exactly what cash is. So cash are the funds that you have immediately available to transact with. So cash is constantly flowing in and out as you make purchases and as you earn. Um, and that cash is going towards things that are immediately used and also things like buying a car, which are things that you have for a long time. So, and of course, there are times where there are needs for cash that are larger. So, for example, when you need to buy a car or need to buy a larger kind of purchase, pay for a vacation, um, the flow of cash is not always even. So, having a buffer of cash is oftentimes pretty important. So, a concept that we use related to cash is liquidity. Many investments, such as a house, stock, or business, are not quickly and easily convertible to cash. So, you can't use those assets to pay for immediate expenses. So, for example, to sell a house, you have to list it on the market. It takes time for a buyer to come around and make an offer, and then it takes a couple of months. So it could take, 3 to 6 months to sell your house. If you had an expense that was coming up right away, it would be pretty slow to kind of use the money from the sale of your house to pay for it. Stocks actually are pretty liquid for the most part. You could sell them pretty quickly, but then let's say you have a gain, you're gonna have to pay tax. So it's not always a cost-free conversion for stock. And then a business is probably even worse than a house. To sell a business may take a long time. And if you're a forced seller, meaning you have to sell the business to pay for something and you're willing to take a lower price, you may not get the best price for your business. There's a saying, asset rich, cash poor. So what does this mean? So I'll give you an example. Um, as part of my real estate business, we would lend money to people that had real estate, and basically to secure our loan, we would record a lien on their real estate. So there was one guy, he had a big mansion in kind of the Bay Area. It was up in the hills, really nice place, and he was looking for $100,000. So this house is probably worth at least a couple $1 million. So he basically needed a couple $100,000 to pay for his son's wedding. And so though he had this very basically valuable house, he also had a business. He was still short of the cash that he needed to basically pay for this expense that was immediately coming up. So he was forced to kind of borrow at a really high interest rate because he was asset rich but cash poor. Why not just hold cash? As soon as you earn money, just keep it in a checking account and just accumulate a bunch of cash. Well, there are a couple of reasons why this is not a optimal strategy. The first one, and probably the most important, is opportunity cost. So we live in a country with many alternatives to invest. So in America, unlike many places in the world, we are basically overrun with investment opportunities and ways to kind of take our cash and put it into an investment to earn. So if you just accumulate cash, you're gonna have a high opportunity cost because you could have put it in the stock market, bonds, invested in a business, um, real estate. There's many ways you could have invested to earn a return on that cash. Another cost of holding cash is if you have a bunch of cash sitting around in your checking account, you may be tempted to overspend. Also, inflation erodes the purchasing power of cash. So, for example, if you tracked the cost of a candy bar from 1910 till now, you'll probably see it's probably like 5 or 10 cents back then, and now it's $1.25. So you can see that the for the same item, the cost in just the in nominal dollar terms is 10 times what it was. And so it's not that the candy bar became more scarce. If anything, the candy bar is more widely available now than it was in 1910. It's just that the value, the purchasing power of the dollar has been eroded over time. So basically, if you had just kept your cash from 1910 in the checking account, um, and then because being a millionaire back then was like probably like being a billionaire now. $1 million is still a lot of money, but it's not the same as it was back in 1910 because again, inflation uh, is kind of uh, a force that works in the economy that is in many ways an indirect tax. Okay, so um, basically the government can uh, print more money to gloss over its own kind of financial mismanagement, and you're not directly taxing people, which people don't like, but it is an indirect form of taxation because the goods and services that we buy just become more expensive. And unfortunately, this harms lower income groups more because they just earn less and they have less investments. So yeah, typically investments at least keep up with inflation. So for lower income people, they just basically have to keep running on this treadmill because the goods and services that they require keep getting more expensive, and maybe their income does not keep up.